Welcome to the comprehensive guide on creating a monthly income portfolio. Today, we bridge the gap between working for money and having your money work for you. A monthly income portfolio is a strategic collection of investments designed to provide regular, stable cash flow every 30 days. Whether you are looking to supplement your salary or cover your retirement expenses, the goal remains the same: consistency and reliability. The first philosophy we explore is the natural income approach. This involves assets that physically pay out cash without you ever having to sell. By living off dividends and interest, you protect your original principal from being depleted, ensuring your wealth lasts for decades. The alternative is the total return approach. Here, you focus on overall growth and sell a small portion of your holdings each month to generate cash. While flexible, this can be risky during market downturns, as selling assets at low prices can permanently shrink your portfolio size. To build a robust portfolio, you must blend several asset classes to balance risk and ensure steady cash flow through any market cycle. Let's start with the cornerstone: dividend stocks. Most companies pay quarterly, but some specifically pay every single month. Famous examples include Realty Income, often called the monthly dividend company, which has a decades-long track record of consistent payouts. You can also use a staggered strategy. By selecting 3 quarterly stocks that pay in different months, you can manufacture a monthly check. For those who prefer a hands-off approach, income ETFs like JEPI offer high monthly yields by combining stocks with option strategies. Next, we have real estate investment trusts, or REITs. These companies own and manage income-producing real estate like apartments and malls. By law, REITs must pay out at least 90% of their taxable income to shareholders, making them powerful income engines. Look for REITs in stable sectors like senior housing or industrial warehouses to ensure your income isn't tied to the volatile retail market. Fixed income through bonds provides the stability your portfolio needs. Bonds pay fixed interest payments, often referred to as coupons. A bond ladder involves buying bonds with different maturity dates. As one matures, you reinvest it, ensuring a constant cycle of cash. Beginners often prefer bond ETFs like AGG or BND, which hold thousands of bonds and distribute interest on a monthly basis. Preferred stocks are hybrid securities. They act like a mix of a stock and a bond, offering higher fixed yields, often around 6%. Business development companies, or BDCs, lend to small businesses. They often offer very high yields because they must pay out most profits. Now let's calculate your income goal. To build your portfolio, you must work backward from the monthly cash flow you actually need. A common benchmark for a safe, sustainable income portfolio is a 5% annual yield. Let's see how that translates to capital. To earn $1,000 a month or $12,000 a year, you would need approximately $240,000 invested. To earn $5,000 a month, you would need $1.2 million at a 5% yield. It's a marathon, not a sprint. While a 10% yield reduces the capital needed, it significantly increases the risk of a dividend cut. Sustainability is key. How should you structure your monthly income portfolio? Diversification across these asset classes is your best defense against volatility. Consider allocating 40% to stable dividend stocks and ETFs. These form the solid foundation of your monthly cash flow. Dedicate 20% to REITs. This gives you exposure to physical real estate income without the headaches of being a landlord. Another 20% should go to bonds or bond ETFs. This provides the ballast to your portfolio, keeping it steady when stocks are volatile. The final 20% can be split between preferred stocks and high-yield covered call ETFs to boost your immediate monthly cash flow. Beware of yield traps. Beginners are often lured by yields of 15 or 20%, which are frequently unsustainable. A yield significantly higher than the industry average is a major red flag. If it looks too good to be true in finance, it usually is. Tax efficiency is your next hurdle. REIT dividends and bond interest are often taxed at higher ordinary income rates. Holding these assets in tax-advantaged accounts like an IRA or 401k can save you thousands of dollars over your investing lifetime. Don't forget inflation risk. If your portfolio pays a fixed amount, that money will buy less in 10 years. You need growth. Look for dividend growth stocks, companies that have a history of increasing their payouts every year to stay ahead of rising costs. Interest rates are another factor. When rates rise, bond prices and REIT values typically fall. Diversity helps mitigate this sensitivity. In recent years, active income ETFs have surged in popularity. These use sophisticated options overlays to provide high monthly distributions. Funds like SPYI allow for participation in market growth while still delivering the monthly cash flow that modern income seekers crave. Getting started is the most important step. You don't need $1 million to begin. You just need a plan and consistency. Automate your contributions. Treat your portfolio like a bill you pay to your future self every single month without fail. In the beginning, consider reinvesting your dividends. This accelerates the compounding effect, growing your income base even faster. Monitor your portfolio quarterly. Ensure the companies you own are still profitable and that their dividend payout ratios remain healthy. A healthy payout ratio is usually below 70% for stocks. If a company pays out more than it earns, the income is at risk. Emotional discipline is your greatest asset. Markets will fluctuate, but your focus should remain on the cash flow, not the daily price. When you focus on income, market crashes can actually be seen as opportunities to buy more yield at a lower price. Building a monthly income portfolio is like building a wall. Each investment is a brick that strengthens your financial foundation. Over time, the compound effect takes over. What started as a few dollars a month eventually covers your grocery bill, then your rent. Ultimately, a monthly income portfolio is about freedom, the freedom to choose how you spend your time without worrying about a paycheck. As we recap, remember the checklist. Diversify your assets, prioritize sustainability over yield, and automate your strategy. Never rely on a single stock or a single sector. A truly monthly income is built on the strength of many different sources. Stay educated. The financial world is always changing, and new income-producing vehicles are created every year. Consult with a financial advisor to tailor these concepts to your specific tax situation and long-term financial goals. Investing for income is a long game. It requires patience, but the reward is a life of financial peace and predictability. Consistency is more important than the initial amount. Even small monthly contributions can grow into an impressive income stream. When choosing REITs, remember to split between sectors like industrial, healthcare, and residential for maximum safety. Focus on dividend aristocrats, companies that have increased their dividends for at least 25 consecutive years. Consider international income as well. Diversifying geographically can protect you from a downturn in any single country's economy. Always maintain a cash reserve. This ensures you never have to sell your income-producing assets during a market panic. The psychology of receiving a monthly payment is powerful. It reinforces your investing habits and makes the journey enjoyable. Rebalance your portfolio annually. This means selling some of your winners to buy more of your underperforming, higher-yielding assets. Aim for sustainable growth. A portfolio that grows its income at 5% a year will double your cash flow every 14 years. An income portfolio can be a legacy. It's a financial engine that can support your family for generations if managed correctly. Avoid asset overlap. Ensure that your ETFs don't all own the same 10 stocks, as this creates hidden concentration risk. Time is your greatest ally. The earlier you start, the less capital you need to reach your monthly income target. Manage your risk by staying diversified, keeping an eye on payout ratios, and avoiding the allure of ultra-high yields. Imagine a life where every month your bills are paid before you even wake up. That is the power of a monthly income portfolio. Make the commitment today. Your future self will thank you for the financial fortress you are starting to build. Start small, stay consistent, and keep learning. Your journey to monthly financial independence begins with a single investment. Thank you for joining us on this deep dive into monthly income investing. We hope this guide serves as your roadmap. The road ahead is clear. With the right strategy and a disciplined mindset, your financial goals are well within reach. Give your portfolio a health checkup today. Are you diversified? Is your yield sustainable? Is your plan automated? Financial freedom isn't about the amount of money you have, but the amount of control you have over your time. Plant your seeds today, nurture them with consistency, and soon you will enjoy the fruit of your labor every single month. Happy investing. Build your portfolio, build your income, and build your life. Goodbye for now.